Conflict in Iran has created uncertainty across global markets. For people nearing retirement or maybe already retiring, volatility can feel really stressful. And joining us this morning is Matt Eilers with Medalist Wealth Management to talk about how retirees can prepare for market ups and downs without kind of panicking when these things are starting to get rocky. Matt, we always appreciate your time. Thank you so much for being here.
It's awesome to be here. Thanks, Tanner.
Yeah, so let's talk about volatility right now. I know our retirees are probably worried about this, especially if they've got a lot invested. The other thing here, too, I want to ask about, who really feels the impact more, the younger investors or our retirees?
That's a really good point that you make there with that question. The younger investor, folks like us, like someone that's in their 30s or their 40s, volatility is very normal and something they experience as they're growing their assets. And if we experience market downturns, how does that affect our life with our retirement dollars? Right now, it really doesn't, because we have sometimes decades to recover those losses. The difference comes when you're actively taking income out of your investment portfolio as a retiree. So if we're not talking about a 35-year-old, maybe we're talking about a 65-year-old.
Yeah.
And let's say we experience volatility or a market downturn, and now all of a sudden we have to take income out of that portfolio that already went down. We're almost doubling down on a loss in that situation and exposing ourselves to really, I think, an unnecessary risk that's called sequence of returns risk, which really can be alleviated through proper financial planning.
Okay, yeah, and you know what? Preparation, as you say, matters more than just, looking at the crystal ball and like maybe throwing a dart and seeing where it lands. How do we prepare in these circumstances when the markets, not just here at home, around the world are this volatile?
Absolutely. It all comes down to planning. Preparedness is one and the same as planning, in my opinion. So in order to avoid being in a situation where we might have to sell assets at a loss, right? Which none of us want to do. We want to buy low, sell high, not the other way around.
Right.
We like to look at diversification differently for retirees versus younger individuals. And for retirees, we should be diversified across different types of purposes. So we want to have some assets that are designated for an emergency fund, right? We want to have assets that are designated for predictable, consistent income in retirement. And a lot of the times, this is one of the most important buckets because we're going to take a different level of risk, a lot of the times no risk, and not be exposed to the market volatility. Market volatility is normal. It's something that's always going to happen if we're invested.
Right.
But let's use assets that can handle the ups and the downs that we're not necessarily dependent on for our lifestyle in retirement. And then the last piece of diversification would be for healthcare expenses. So, younger individuals don't have to really think about this stuff yet because they've got years and years to plan for it. But when you reach retirement, the priorities really shift. We have to have a plan that prepares you for consistent, reliable income and then allows you to have the proper risk that you're exposed to on your growth assets.
Let's zoom out just for a second. The conflict, it's been happening since the end of February. How have you seen that as an expert impact the markets and how has that contributed to the volatility that we see today?
Well, the markets, and I've said this on segments before, the markets hate uncertainty. The markets are a lot like a high schooler. They overreact. They tend to be overly emotional. But what it's done, it's all about emotion. That's what we've seen. Emotion spikes volatility. So emotion really is the enemy of investors. It's what causes people to, buy high and sell low, so to speak. So when emotion spikes, that is going to be a really bad recipe to go into the bowl with volatility. So I think a lot of investors right now are just wondering, like, okay, what does this mean for me? What does this mean for my situation? Because, you could, depending on what station you look at your market headlines, you could think the sky is falling or you could think the economy is booming. I think the key here, Tanner, is to tune out any emotional response to this and let's just look at fundamental planning data. Let's look at the math, let's look at the logic, let's run the numbers about what does this really mean to you. And I think it's a heck of a lot easier to handle, unpredictable markets because we cannot predict them.
Right.
But it's a lot easier to handle that if we've got the right plan in place, especially one that separates income from growth.
Yeah, and mistakes when we're talking about this, obviously making knee-jerk reactions might be a mistake in that scenario.
Yeah, absolutely. And what we find with families that have the right financial plan in place that separate income from growth, they don't have the need to make those emotional mistakes, because if they know, all right, I've got consistent, predictable income from assets that I've designated for that purpose, and the markets aren't affecting that asset class, then they're not as apt to say, oh, I have to go sell emotionally. We can actually build some time into their portfolio like the young investors have. We can build that into the growth bucket by just separating the two.
Interesting. All right, so when you're looking at it in today's world, so like if we're just logging on to our market portfolios today,
Yep.
What are we focusing on, or what at least should we be zeroing in on, if anything?
Yeah, well, if we're still speaking about the retiree, I think it all comes down to income and risk. So first off, are you taking the right amount of risk that you're actually acceptable with? So a lot of people have a different risk tolerance than how they're actually invested. And the tricky thing is they're not quite sure how to figure out, like, what should I actually be invested in based on how much risk I like to take. We see retirees, their risk tolerance tends to decline a little bit, which is normal as people age. But it's understanding, do you own the right stuff based on your risk?
Yeah.
Very, very importantly. But then also, do we have assets that are set aside that can be used for income that are not going to experience the volatility? So it's looking at that and allowing someone to kind of audit and run a diagnostic of your financial situation and understand, all right, what happens if the market drops 20%? How does that affect your income, and building a plan around being able to handle that?
Okay, Matt Eilers, we have to leave it there. We always appreciate your help. Thank you so much for helping us understand this.
Always glad to be here.